Hey guys, Mr. Tower here with your e-learning lesson for April the 20th. Today we're going to dive into our third type of company structure, and that is corporations. We've already talked about sole proprietorships. On Friday we discussed partnerships and LLCs. Today we're going to look into corporations. So let's first start with how a corporation works. A corporation is a form of business where the business organization is chartered by a state and acts as a separate entity from its owners. So already we're vastly different than a sole proprietorship. We are chartered by a state, so we're very, very much under the control of the government. And also the company acts as a complete separate entity from its owners. So that is something that's very, very different than a sole proprietorship also. And the main advantage of a corporation is that it provides limited liability to its owners. Okay, so basically, it prevents you from losing more than what you have invested. So instead of, whereas a sole proprietorship, you as the owner held all of the liability, meaning that you had unlimited liability. If the company went bankrupt, you could lose everything. If you set your company up as a corporation, you can't lose more than what you invest. Basically, you can only lose what you have invested in the stock, and you can't lose anything in addition to that. Corporations also have different tax structures than other business structures. So the way that they are taxed is quite different than that of a sole proprietorship or even a partnership. So some of the characteristics of a corporation, the main one is that owners own shares or stock, and that stock signifies a certain stake or a certain percentage of ownership in a corporation. So basically, the more stock you own, the higher percentage of that company that you own. So, for example, if a company has 10,000 shares of stock available and one person owns 500 of those shares, that person owns 5% of that company. Okay, if that person owned 1,000 shares, they would own 10% of that company. So if you were to go and purchase a share of John Deere, okay, you would own a certain percentage of John Deere. Now, if you only owned one share, it would be a very small percentage, but you would still own a certain percentage. If a stockholder owns a significant amount of shares, he or she may have a vote on company positions, such as the board who represents the stockholders. So all corporations have a board, executive board, or board of directors who actually lead the company. The shareholders don't show up at work every day and make decisions. Okay, they simply own the stock. Corporations will have a shareholder meeting once a year where they will vote on important company issues. And one of the things that they might vote on is who's on that board that represents the shareholders. And if the company's not doing very well, well, maybe they will vote to replace people on that board. So you don't always get a vote. If you just have one, if you own one share of a company, you're probably not going to get to vote on things. But if you, own 10, 15, 20% of a company, you're probably going to get a vote. If a stockholder does not own a significant amount of shares, you don't get a vote in company decisions. The idea behind that is if you own a big portion of the company, what happens in that company matters a lot more to you than to someone who maybe only owns a few shares. Typically, corporations will have a chief executive officer or a CEO or a chief financial officer or a CFO. And that person runs the company on behalf of the stockholders. So they report to the stockholders, they work for the stockholders, and they run the day-to-day operations of the company. So a corporation raises capital by selling shares of stock. The idea is that they sell those shares, they take the money generated by selling those shares and they reinvest it in the company. So maybe you've got a company that wants to build a new manufacturing facility. Well, to finance the building of that facility, they might sell shares of stock in the company, and then whatever those shares sell for, they will take that money and use it to build their new manufacturing facility. So the idea is that a lot of people will invest money into those stocks, and as the business gains success, the stock value will increase. Buy low, sell high. Okay, it's real similar to when we talked about commodity trading in the fall. Same concepts here. Okay, and uh, it's important that when you buy stock, that it's in a company that you believe in, that you think is going to be successful and continue to grow. Because if that company continues to grow, then the value of that stock will continue to grow. One key thing that distinguishes a corporation from a partnership or a sole proprietorship is that the corporation is transferable upon death because stockholders can independently determine the beneficiaries of their shares. There's not one person who owns, you know, uh, the entire company. And it's owned by several shareholders. So when those shareholders die, they can choose who to pass their stock on to, and things keep on going. Okay, so it is uh, if you're looking to sustain a company over a long period of time, several generations, corporation is a good structure to utilize. Corporations do exist that do not have shareholders, okay, because their corporation has members. So non-for-profit, not-for-profit operations will operate this way. And the reason why they can operate this way is because they don't have making money as a goal. They're raising money for some sort of a charitable cause. Profit is not something that is important to them. They're looking, towards other goals. So uh, those things do exist where they don't have shareholders, they have members. So there's four basic types of corporation. The first is a C corporation. And a C corporation is the most common type of corporation. Basically, a C corporation creates a separate legal entity, assets and liabilities separate from the owners. So a C corporation creates a completely separate legal business entity that's separate from the business of the owners. So another thing about a C corporation is that they have publicly traded stock. So oftentimes companies will start off as partnerships or sole proprietorships, and then they reach a point where it's time to grow and it's time to get bigger. And the way that they choose to get bigger is they choose to offer stock in the company. They call that an IPO, an initial public offering. Okay? And basically, once a company becomes a corporation, one of the stipulations is that they have to publicly trade stock, and that first offering of those stock is called an IPO. So once you set your company up as a C corporation, it removes that liability from the original owners, but it also takes away some of the control, a lot of the control actually, because you're going from, a sole proprietorship where you made all the decisions to a corporation where, you don't necessarily have the ability to make those decisions. Some of that power lies with your shareholders. So the advantages of a C corporation, the owner's personal assets are protected from debt and liability. Corporations have unlimited life. Not that a corporation can't go out of business because they can, but finances have to result in that. Uh, Death or illness in the ownership can't cause a corporation to go away. There are tax-free benefits. Insurance, travel, and retirement plan deductions can't be taxed within a corporation. Transfer of ownership is facilitated by the sale of stock. It's very easy to transfer ownership with a corporation. You just sell stock to people. Um, a change in ownership doesn't need to affect management. Changes in ownership happen all the time as stock continues to trade hands. And it is quite easy to raise capital just through the sale of stocks. Disadvantages, though, it is quite a bit more expensive to form. There's a lot of legal fees involved. You're going to have, lots of money wrapped up in attorneys and lawyers putting together the paperwork and making sure everything is on the up and up with the government. Um, Far more legal formalities, far more regulations. Um, you are heavily regulated by state and federal rules and regulations within a C corporation. The second type of corporation is an S corporation. And basically, an S corporation is selected when shareholders are taxed as the sole proprietor. So uh, basically, an S corporation reports all profits through its owners as personal income. So a little bit different, not quite as much separation between owner and company. A closed corporation is similar to a C corporation, but it's designed for a company with a sole owner and a small group of owners, usually not to exceed 30 shareholders. So these are usually smaller companies that want the protection of a corporation, but they don't want to offer uh, shares or stock to the general public. So uh, that's a smaller type of corporation. An LLC, we've talked about LLCs a little bit, it's kind of like an S corporation. It's taxed like a partnership, but it provides that protection of limited liability. Okay, and LLCs will usually not have stock. So, how do you form a C corporation? The most common type of corporation, how do you do it? So, first of all, you need to choose a business name that complies with state laws. It's necessary to appoint directors of the operation, so you need to appoint a board of directors. You have to file the formal paperwork, which is the articles of incorporation with the state and federal government. You need to create a set of bylaws that explain how the company operates and the rules of how that company operates. You need to hold a meeting with the board of directors to approve all that paperwork. And then once you're ready to issue stock, you need to issue stock certificates. And that stock certificate simply serves as uh, tangible proof of stock ownership. Then you have to obtain all your licenses and permits to operate from local, state, and federal governments as well. So to be treated as an S corporation, you have to be a domestic corporation or an LLC. You can only have one type of stock. You can't have no more than 100 shareholders. All shareholders must be United States citizens. Profits and losses must be allocated to shareholders proportionally according to the amount of stock they own. So some of the differences between C and S corporations: C corporations are allowed to keep their profits. S corporations have to uh, pay out dividends, more dividends, I should say. And a dividend is extra money made by the corporation, and that's given back to the shareholders. So basically, as a shareholder, you're entitled to a percentage of the profits. And if you hold stocks or shares in a company, that company has a profitable, successful year, you'll receive a dividend check, which is a percentage of those profits that you're entitled to. So, in review, um, in review, real quick, and we'll finish up. C corporations also have a lot of additional requirements. They have to have an annual report. They have to have a board of directors. They have to report a lot of stuff to the federal government. S corporations uh, pass those profits on to the shareholders, and they pay a tax on those profits. Okay. All right, guys. That's it for today. Uh, you have an assignment on Canvas to complete on corporations. Keep in mind your assignment is due tomorrow night by 11:59. So if you have any questions, feel free to reach out. Otherwise, have a great day. Thanks.